This is Nightly Business Report with Bill Griffith and Sue Herrera.
Stocks seesaw. The markets saw sharp losses and gains as investors navigate a world with higher interest rates and rework their portfolios.
Labor shortage. Delivery company DHL is looking for workers as it enters its busy time of the year.
Hot holiday toys. Get your gift list ready. The retailers are stocking up in the hopes of getting a bigger slice of the toy market now that Toys R Us is gone. Those stories and more tonight on Nightly Business Report for Monday, October 8th.
And we do bid you good evening, everybody, and welcome. It was one of those days when the stock market just couldn't seem to make up its mind. The Dow swung between a 200-point decline in the morning and a nearly 100-point gain in the afternoon. The rout in technology shares continued to deepen, and the S&P just kind of floundered during the day. In the end, the industrial average rose by just 39 points to 26,486. The Nasdaq fell another 52 points, and the S&P was down just 1. The bond market was closed today for the Columbus Day holiday, but clearly interest rates were still on the minds of stock traders following last week's dramatic rise in Treasury yields. The question remains, why have yields spiked? Is it because inflation is soon to be a problem, or is it simply because the economy is on solid footing? And if that's the case, should equity investors really be as concerned if it's for all the right reasons? Mike Santoli digs into that for us tonight.
Over time, it's true, stocks can do well as bond yields climb and the Federal Reserve lifts rates due to strong economic growth, low unemployment, and more normal levels of inflation. And in fact, the 10-year Treasury has doubled over the past 2 years from a yield of 1.6% to 3.2%, and during that time, the S&P 500 is up by more than 30%. Yet at this stage, 3 years into a Fed tightening campaign, each fresh high in bond yields is a test for stock market valuations that are down from January but remain near the upper end of their long-term range. The stock market's price-to-earnings multiple is as high relative to bond yields as it's been since 2008. For sure, stocks were a good deal more expensive compared to bonds for most of the decade before the financial crisis, but so far during this economic expansion, the market has refused to restore that premium to stocks. Higher yields also act as a headwind to earnings and corporate investment by raising the cost of debt. Corporate bond yields are at a 2.5-year high, which pinches heavily indebted companies, including many smaller firms. And of course, with yields on safe government bonds now exceeding 3%, they start to appear more attractive to investors relative to expected 10-year stock returns, which many strategists argue could be in the mid-single digits from here. All of this helps explain why the stock market has stalled out when yields reach a new higher threshold as investors try to make their peace with a higher cost of money and look for reassurance that rising rates won't hasten a slowdown in an economy that's already seen decelerating a bit heading into the new year. For Nightly Business Report, I'm Mike Santoli.
So what does the rise in rates mean for individual sectors? Bob Pisani breaks that down.
The relentless rise of interest rates has moved the ETF business in a big way in the last few days. Now, we have seen particularly heavy volume in bond ETFs in the last week. Treasury ETFs in particular, right across the yield curve, the 3 to 7 year Treasury ETF, the 7 to 10 year, and the 10 to 20 year. We've also seen very heavy volume in the main investment grade corporate ETF, that's the LQD. They're all hitting new lows, by the way. Looking at stock ETFs, the usual sectors that get hit by higher rates are taking a beating. We've seen new lows, for example, in the ETFs around emerging markets, around home builders, around global automobile stocks, and even casino gaming stocks, which are often highly leveraged and can be very susceptible to sudden moves in interest rates. But look carefully, and you'll see that the strong economy is helping other sectors that might normally suffer under higher rates. So REITs, real estate investment trusts, this is a classic rate-sensitive sector. They're down, yes, but they're not even close to new lows, and that's partly because the economy is so strong and sectors that real estate services, healthcare, storage, apartments, and even hotels, they're all doing well. Also note that the high-yield ETFs like HYG are also down, but they're not at new lows, and for a good reason. Those high-yield ETFs are more tied to the credit cycle than the interest rate cycle. And with the economy being so strong, the risk of default is still fairly low. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So with this recent dramatic rise in interest rates, is there a model portfolio that could benefit from these rising rates? Michael Jones is with us tonight. He's chairman of Riverfront Investment Group. He's got some ideas on that. Michael, thanks for joining us tonight.
Glad to be here.
So if you had to start from scratch, as rates rise here, give us a sense, broadly speaking, and this is broadly speaking, not just for every single individual investor out there. What kind of a mix would you see for stocks to bonds right now?
Well, I think that mix is changing in response to what's happening in the bond market. If you look back over the last 10 years, bonds have been very expensive. Interest rates have been extremely low. They just haven't been a good deal. By the same token, stocks have been pretty cheap. They've been offering great returns. If you look at our portfolios, we've had an overweight to stocks of between 10 and 15% for most of the last decade, and we've taken that money out of bonds. As you look at what's happening right now, with interest rates starting to rise and equity markets getting high enough that they're starting to tip into overvalued territory, now's a good time to take that extra money that you've been keeping in equities for the last 10 years, because it's the only thing that made sense with zero interest rates, and start shifting that back over into the bond market, but into very specific sectors of the bond market.
So would you go very short term in terms of bond exposure?
I think what the market has done is a great favor to investors, because the most attractive space in the bond market right now is the safest space. 2- and 3-year treasuries right now are offering yields of close to 3%. If you wanted a yield like that 6 months ago, you had to lock your money up for 30 years. You're now able to get that kind of return for a 2- or 3-year investment. And, you know, Bob was talking about high yield bonds. They're only yielding 5.5% for
right.
all the risk of default that you have to take on when you invest in junk bonds. With treasuries, 2-year treasuries with very little interest rate risk and no credit risk offering 3%, now's a good time to shift some of your portfolio from the risky part of the market into the safest part.
And what about equities? I mean, the Econ 101 suggests as rising rates continue, financials are a place to go. Is that where you look? And what about technology? It's still getting clobbered these days.
Well, let's talk about technology first, because we'll get the bad news over with. I just came back from an extended due diligence trip into Asia, and the undeniable conclusion is that China's losing the trade war. What has that got to do with technology? Well, everyone is now realizing that it's too risky to source all of your production from China. I mean, 90% of PCs are made in China, 70% of phone handsets. And suddenly you can be denied access to your products or have to pay a big tariff on those products if the President of the United States signs a certain act.
Okay.
So what companies are recognizing is they've got to diversify out of China. They've got to find new supply sources. They've got to build new supply chains. That's incredibly expensive, and it's going to be a pretty big headwind for tech earnings for the next several years.
Very quickly,
and
then,
that's
where would you put the money then to benefit from rising interest rates?
You hit the nail on the head. Banks have had zero interest rates that they've paid on checking accounts, and they've been able to invest the money at zero. That's not very profitable business. They're now keeping interest rates that they pay us on our checking accounts close to zero, but they're able to invest that cash at 2.5%, even 3%. That's a significant boost to bank profitability that they haven't had for the last 10 years, and it's going to really help their stock. I also like financials in the insurance space, because after you've had a series of disasters, and it looks like we're about to have another one, unfortunately, in Florida and possibly the Gulf Coast.
Okay.
You know, it is very bad for those stocks short term as they absorb those losses, but it gives them pricing power for the next year or two that really helps their earnings and their stock price.
Michael Jones with Riverfront Investment Group. Again, thanks for joining us tonight. Appreciate it.
My pleasure. Thanks.
Well, the energy markets are watching what Michael just mentioned, Hurricane Michael. The intensifying storm is tracking through the energy-producing area of the Gulf of Mexico, and it is expected to make landfall near the Florida Panhandle. According to the U.S. Energy Information Administration, offshore production in the Gulf accounts for 17% of total U.S. crude output. Energy traders were also watching a, quote, major incident at Canada's largest refinery in St. John, New Brunswick. Today, oil prices settled at about $74 a barrel.
And overall, oil prices are up more than 20% so far this year, and that's pressuring airline stocks because certainly higher fuel costs cut into profits and perhaps lead to higher airfares. Phil LeBeau has more on that for us.
The next time you see the ground crew fueling up your plane before takeoff, remember this: that fuel is the reason airfares are likely to move higher. Historically, airfares move up or down in tandem with jet fuel. And now that it costs more to take off, airlines are likely to pass along those higher costs. Admittedly, fares have been trending lower in recent years, with the average domestic round-trip ticket now costing $217. But airlines have been able to boost revenue by charging customers to change reservations, upgrade their seats, and check bags. In fact, almost all of the major airlines have recently raised the cost of checking your first bag from $25 to $30. That will help airlines offset higher fuel costs, as will the fact there's a record number of people flying right now. Demand is strong. Historically, airline stocks move higher in the fall in anticipation of a busy holiday season. We'll see if that's the case this year when airlines start reporting earnings later this week. Phil LeBeau, Nightly Business Report, Chicago.
And rising oil prices are pushing up the price of gasoline. According to industry analyst Trilby Lundberg, the price of a gallon of gas is up 7 cents over the past 2 weeks to $2.97 a gallon. That is 41 cents higher than a year ago. Los Angeles has the highest price in the contiguous 48 states at $3.82. The lowest is in Houston at $2.58.
General Motors sales in China have shifted into reverse. The company announced today that sales there fell by 15% in the third quarter. That was the first decline in more than a year. And in fact, auto sales in China overall have been falling broadly recently, with analysts saying that the slowing economy in China and trade frictions with the U.S. are starting to make consumers more cautious.
It's that time to take a look at some of today's upgrades and downgrades. General Electric was upgraded to overweight from equal weight at Barclays. The analyst cites the new CEO's ability to lead a turnaround and added that most of the bad news is already priced into the stock.
Investors are basically saying at this price, power, renewables, transportation, Baker Hughes, GE, all of that collectively is worth zero. And we think that's too harsh.
The price target is $16, but the firm puts the stock at $20 in a so-called blue sky scenario. Shares of GE rose 3% to $13.61. Apple's price target was hiked to $2.65 at Citi. The analyst cites higher average product selling prices and strong margins. The firm maintains a buy rating on the stock, but nonetheless, the stock fell a fraction to $223.77.
Square's price target was raised to 108 at Goldman Sachs. The analyst there cited margin expansion and revenue growth. The firm maintained its buy rating on the stock in the meantime. But concerns over Square's credit risk sent that stock lower by about 8% today to 86.06. Conagra was upgraded to buy from neutral at UBS. The analyst cited the company's long-term growth potential following its acquisition of Pinnacle Foods. Price target now $40. Shares rose by 3% to $34.65.
Still ahead, the benefits of rising interest rates and what they could mean for you.
Two American economists have won the Nobel Prize in Economics for their work on understanding how economies can grow sustainably. William Nordhaus is a professor at Yale University. He's best known for his work on climate economics, and he developed a model that examines the effects of climate policy like carbon taxes on the global economy. Meanwhile, Paul Romer is a professor at NYU, New York University. His work has shown how economic forces govern the willingness of companies to innovate.
The Teamsters Union approved a deal with UPS, even though most of its members voted against it. Since a majority of members did not vote at all, and because 2/3 of those who did vote did not oppose the contract, it was ratified. But the decision could cause a rise in tensions between factions within the Teamsters. And all of this comes as companies like UPS ramp up for the busy holiday season.
And it's not just UPS ramping up for the holiday rush. DHL is as well, and its ability to navigate the tremendous growth in e-commerce depends on its ability to hire the right workers despite the current labor shortage. Frank Holland is in Lockbourne, Ohio for us tonight.
Workers are in the driver's seat for the companies that move and deliver all the things Americans buy online.
I want a company that's going to invest in me, in my career goals, and they have done that so far.
Jennifer Roger left a job as a teacher to work here for the flexibility it offered. And now she's become the student in her professional life.
To be honest with you, I was not handy with a computer when I first got here. I have learned how to use a computer. I've learned how to use a laptop. I've learned how to use Microsoft. So for me, that was the most rewarding experience ever. Just like basic learning technology on a computer.
That kind of training, along with competitive pay, access to new technology, and employee perks, are just some of the ways that DHL supply chain says it attracts and retains top talent.
We really rely on motivating employees in order for us to successfully service customers. When we can't find the right associate, that impacts our ability to deliver service to customers and impacts the margin of our business.
There is only one qualified person for every 6 openings in this kind of work, according to a supply chain management review report. That global shortage, along with competition from Amazon, which recently raised its minimum wage to $15 an hour and has 2 facilities within 30 minutes of this one, has amped up competition for workers.
We are finding that we have to interview or consider about 10 candidates for every hire that we have. So in our efforts to build a pool, we have to build a pretty substantial pool in order to find the right talent that we're looking for.
DHL and other supply chain companies need workers for assembling and packing orders, along with others for technical and operational work that can often require specialized skills and college degrees. This facility handles 100% of the orders for Rodan & Fields, the #1 skincare brand in the U.S. Management hopes to expand this workforce by 25% by the end of next year, but they say they can't maintain the productivity and profitability unless they hire the right people. Technology is also becoming increasingly important as the company strives to improve efficiency by integrating robots and AI tech like Google Glass into their facilities. It also helps to attract top talent. For Nightly Business Report, I'm Frank Holland in Lockbourne, Ohio.
Google exposed user data. That's where we begin tonight's market focus. Alphabet's Google exposed the private data of hundreds of thousands of users of its Google Plus social network. According to the Wall Street Journal, Google opted not to disclose the issue, in part because of concerns over regulatory scrutiny. Access to the data occurred between 2015 and early this year. The company is also shutting down Google Plus. Shares of Alphabet fell 1% on the day to $1,155.92. A group of private equity firms are going after Arconic. According to reports, Blackstone, the Carlyle Group, and others have joined forces in a bid to acquire the aluminum products maker Arconic. The consortium does, however, face competition from other buyout firms. An activist investor in the stock has reportedly been pushing Arconic to explore a sale. Shares of Arconic were up 7% to $23.40. And the paint and coatings company PPG is raising the price of its car paint by an average of 10%. This to combat a rise in raw materials, freight, distribution, and labor costs. But after the bell, the company warned that its third quarter results will be impacted by softening demand in China and foreign currency fluctuations. After closing higher, it immediately sold off in after-hours trading.
Barnes & Noble extended its gains in the market today following a report in Barron's over the weekend that said the stock could rise further. Last week, recall, shares got a lift on the news that the bookseller is entertaining bids from interested buyers. Today, Barnes & Noble rose another 1% to $7.02. Walmart is taking on Netflix and Hulu. The retailer is partnering with movie studio Metro-Goldwyn-Mayer to create content for its video-on-demand service called Vudu. Walmart purchased Vudu 8 years ago, and it's looking for ways to increase its monthly viewership. Shares rose 1.5% today to 94.69. And reports say that a unit of Garmin accidentally exposed the data of hundreds of thousands of boat owners who used its GPS devices. The company says the vulnerability was due to a misconfiguration in one of its backup databases. Garmin said that it investigated and resolved that issue once it was notified of the breach, and shares fell by 1% today to 67.85.
Well, after the Fed's recent rate hike and with another increase potentially before the end of the year, many on Main Street are focused on what those rising rates will cost them. It will be more expensive for many borrowers, but there are also some benefits to rising interest rates. Sharon Epperson joins us now to explain that. It's always good to see you, Sharon.
Good to be here. Good to be
So
here.
let's look at the silver lining. What are some of the benefits?
Well, start with higher returns for savers. That's the good news for many savers out there, including retirees who are going to see more interest income. Great news for them as well. And then we're going to see more credit availability also. We're already starting to see that compared to a few years ago.
But we know, relatively speaking, savings rates are pretty low still. So how much can we expect to earn on savings accounts?
The key is to find the right high-yield savings account. And if you look at the national average being 0.9%, you can see a top rate on a high-yield savings account over 2%, and that's what you want to shoot for. You want to try to get a rate that high. You have to go to an online bank most likely to get that rate. They're very competitive. Make sure it's FDIC insured, and that's a great place to go. Also for savers and for retirees looking to tie up their money maybe for a year, maybe longer, the CD rates are improving also 2.5% or more for a 1-year CD. If you can tie it up for 3 years or more, you can get over 3% on a 3-year or a 5-year CD, and that's a significant increase than what we've seen in the past.
Absolutely. On the flip side, and there's always a flip side, borrowers are going to end up paying more.
Well, if you're a very credit-worthy borrower, the good news, because I'm always trying to find a silver lining here, is that there is more credit available. So banks want to loan out now at these higher rates. So that means products that may not have been available before are now available for folks.
Good point.
Again, you have to have good credit for that. But we are seeing rates rise for credit cards, and that's one where you're like, that's where you're going to get hit. 17% on average for the minimum for a credit card rate, according to creditcard.com. You add to that the rate point increases, and we're going to see that within the next billing cycle. The reward there, pay it down now. Then you won't have to pay more. Don't get complacent thinking it's just a little bit on my monthly statement. It's going to start to add up. You could carry that debt for decades.
Always look on the bright side
Always
of life.
look on the bright side. Definitely when it comes to your money.
Monty Python and Sharon Epperson. With those lines.
Thanks, Sharon, as always.
Sure.
And coming up, the hottest toys coming this holiday season.
Apple has taken the unusual step of sending a letter to Congress denying last week's report that it had fallen victim to a hardware hack perpetrated by China. That letter says that the Bloomberg report provided no evidence to substantiate their claims and that Apple's internal investigation found those claims to be false. The report singled out Apple and Amazon as two prominent victims of the attack.
Microsoft is pausing its Windows 10 update. This after reports that customers who downloaded the latest upgrade called 1809 discovered that most of their personal files like Word documents and photos had been permanently deleted. The root cause of the issue has yet to be determined. And by the way, only files in the Documents folder appear to have been affected. And Microsoft now says it has the tools to help try and recover those deleted files.
Well, it may be October, but the nation's major retailers are planning now for the holiday shopping season. With Toys R Us gone, they are competing more aggressively for your dollars, hoping you buy the hottest holiday toys at their stores. Courtney Reagan has more.
Many of the hottest holiday toys fit into categories of unboxing or some element of surprise and collectability, and wearable pets. Add updates of past year's favorites and you get this year's hottest toys. Private toy maker MGA Entertainment says its LOL Surprise toys are the top-selling toy around the world so far this year. LOL Surprise Biggie Pets and LOL Surprise Bigger Surprise are indeed topping hot toy lists and getting harder to find.
LOL hits the shelves or hits online, and then it's immediately sold out. As we get a little closer to the holidays, there'll be more. In the board game area, there's a game called Relative Insanity. Now, that's Jeff Foxworthy's game, and that game has been blowing out. There's already a short supply.
Silver says Pomsies, the plush wearable pet toy made by Skyrocket, is this year's fingerlings, which are also still popular. Just Play's Hair Doorables, these are collectible surprise dolls and accessories, also top mini hot toy list. Canadian toy maker Spin Master has a new Hatchimal this year, Hatchababies, and it just launched last week. Classic toys like Mattel's Barbie Dreamhouse and Lego's Harry Potter Hogwarts Great Hall will also be on wish lists. Half of the year's toy sales are done during the holiday season, and with the liquidation of Toys R Us, other retailers are clamoring to pick up share. Analysts at B. Riley FBR surveyed consumers asking where they would buy toys now that Toys R Us is gone. Walmart, Amazon, and Target top the list. Still, some think the big box retailers won't totally make up for Toys R Us sales in the days right before Christmas.
The last 4 days, Toys R Us did $500 million in sales. It's staggering the amount of volume that they move through the store. Now, Walmart and Target, I don't know if they're set up to move that type of volume in 4 days. With Amazon the last 4 days, consumers are reluctant to place an order that close to Christmas because, am I going to get it in time?
This holiday season will be a test for parents in search of the hottest toys and for retailers hoping to fill the void. For Nightly Business Report, I'm Courtney Reagan.
And before we go, one last look at the day on Wall Street. No bond trading today because of Columbus Day. The Dow rose 39. The Nasdaq fell another 52 today. The S&P was down just a point.
And that'll do it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. Happy Columbus Day.
Yes.
See you tomorrow.
Indeed.